Hi everybody, Jeff Yasteen here. You know, if you bought Beyond Meat when I told you to, and that was on April 8th when the stock was trading at around $66 a share, let me know in the comments column, and congratulations on a very rapid 50% gain or thereabouts. And if you missed out, don't worry. After an analyst downgraded the stock on Monday because of valuation worries, Wall Street is now giving you a second opportunity to buy this stock yet again. And as I tell my Total Wealth Insider newsletter subscribers all the time, that's how it works with out-of-favor stocks and out-of-favor growth stocks like Beyond Meat. When they're down in price, as Beyond Meat was at $50 a share only a handful of weeks ago, they look risky. And that's often because the shares appear new and unfamiliar to many investors on Main Street, and the stock is yet to develop a following on Wall Street with their institutional traders. And of course, no one wants to recommend or be seen buying a stock that's headed south in a hurry. And that's a big reason why Goldman Sachs gave the stock a sell rating just as the shares began to rally, again, just a few weeks ago. Now, when a stock has gone way up in price like this one, they look even more risky to the uninitiated, and that's because investors are buying in anticipation of bigger profits yet to come in future quarters. And again, that's part of the reason why UBS downgraded the stock on Monday, was because of valuation. But again, investors are buying in future quarters. They're anticipating those future quarters of bigger profits coming down the line. So here's the thing nobody ever tells you when you're buying growth stocks. They never look truly cheap, even in the worst of sell-offs. And we certainly saw that with Beyond Meat in the last couple of months. But then again, all things being equal, how much would you pay to own shares in a company where the profits are going to triple over the next year and then double again to $1.20 a share by 2022? So again, that's the key to owning growth stocks. You're buying in anticipation of those bigger profits coming down the line. Now let's also consider the stream of news coming from the company. Beyond Meat went in with Starbucks earlier this year to bring out a meatless breakfast patty. That was in February, that they brought to their Starbucks US and Canadian stores. Last week, the two firms announced that they're also going to do the same thing in China as well. So that brings up a good question, which is, what about competitors such as Cargill, which paired up with KFC China to bring out a plant-based, poultry-less chicken nugget product? They're going to test it in China. Well, Beyond Meat has never lacked for competition, and it was one of my concerns when I first said to avoid the stock after it had its IPO last year. And of course, it was much, much higher in share price back then. But since then, I think that Beyond Meat has developed that rarest of all commodities and the most valuable of all commodities, and that is a trusted consumer brand name. I think investors and I think the general public are willing to pay more to eat a product coming from Beyond Meat versus a lot of the other sort of Me Too products that are beginning to emerge out there. The other thing to think about is that the meatless market is growing very, very rapidly. It's going to be about an $8 billion market by 2024, growing at about 8% a year. The long and short of it is there's plenty of growth here. There's plenty of room here for all companies to come in. But Beyond Meat, I think, appears well on its way to being the premium player in this sector. And it should then continue to garner a premium stock price from here on for investors now and in the years to come. If you like what I'm talking about, make sure to subscribe to my YouTube channel and to keep following me on social media. I'm Jeff Yasteen, wishing you the best of goodbyes.